Myth number 1. IULs are investments. Some people think an indexed universal life policy works just like investing in the stock market, but that's not true. An IUL is first and foremost life insurance with the added benefit of growth potential. It's designed to protect your money from losses while giving you tax-free growth opportunities. You won't get unlimited market returns, but you will get steady, protected growth. With regular check-ins, you can adjust your allocations and manage loans to keep the policy working for you. Angela, age 45, learned this firsthand. She expected stock-like gains, but discovered her IUL was really a safe, long-term wealth-building tool. Myth number 2. IULs are too good to be true. At first glance, an IUL can sound almost magical. Growth, protection, and tax-free income all in one. But it's not magic. It's a carefully structured financial tool. Think of it as combining things you already know: life insurance, market-linked growth, and tax advantages. The key is that it protects you from losses with a 0% floor, while still letting you capture upside when markets rise. David, age 50, was skeptical, but once he saw how the floor worked, he realized it wasn't too good to be true. It was simply smart planning. Myth number 3. I can lose my money. Here's the truth. With an IUL, zero is your hero. When markets drop, your cash value doesn't lose money. It's protected. That means no painful recovery period like traditional investments. Sarah, age 58, moved part of her savings into an IUL. When the market fell by double digits, her policy credited 0%. No loss. And when the market rebounded, she captured the upside. For her, it was the first time a bad market didn't ruin her retirement plan. Myth number 4. IUL fees are too high. Yes, IULs have higher fees in the early years, but those costs are front-loaded, not permanent. By around year 10, most premiums flow directly into tax-free cash value growth. Think of it like planting a tree. The early years require care and investment, but once it matures, the growth is steady and strong. Trinity, age 40, worried about fees compared to her brokerage account, but once she understood that early costs were temporary and long-term growth could outpace taxable accounts, she saw the fees as an investment in financial strength. Myth number 5. IULs have unlimited upside. An IUL doesn't give you the full market gains. Instead, growth is indexed. You capture a portion of the upside, limited by caps and participation rates. In exchange, you're protected from losses. Think of the stock market as a highway where cars can speed, slam brakes, or crash. An IUL is more like a train. Steady, guided, with speed limits that keep it safe. You trade the wild highs for smooth, reliable forward movement. Over time, that stability can actually outperform the market during turbulent years. Myth number 6. IULs are only for the wealthy. Many people assume IULs are only for high earners. In reality, they're accessible to families at many income levels. Smart planning matters more than large contributions. Flexible funding allows you to start small and grow over time. Emily and John, in their mid-30s, contribute $250 a month. By age 65, their policy is projected to grow to nearly $400,000, while also providing $250,000 of life insurance protection. It's not about being wealthy, it's about being consistent. Myth number 7. Cash value grows quickly from day one. Early cash value growth in an IUL is modest because of fees and setup costs, but growth accelerates as the policy matures. With steady contributions and annual reviews, the long-term results can be powerful. Mark and Lisa, a couple in their 30s, expected fast growth right away. Instead, they saw slow accumulation at first, but over time, their policy grew into a meaningful source of protection and opportunity. Patience and consistency are the keys. Myth number 8. IULs are too complicated to understand. At first, the mechanics of an IUL, caps, floors, participation rates, can seem overwhelming. But the core concept is simple. It's life insurance combined with tax-advantaged growth. Once you understand the basics, you can make informed decisions and use the policy confidently. Rachel, age 40, avoided IULs for years because she thought they were confusing. One clear explanation changed her mind. Now she reviews her policy annually and uses it as a flexible tool for her future. Myth number 9. IULs aren't flexible. Flexibility is one of the strengths of an IUL. Many policies allow you to adjust premiums, take loans, or make withdrawals. That means you can adapt to life changes while still protecting long-term growth. David, age 52, experienced a career change and adjusted his premiums to match his new income. His policy continued to grow without losing coverage. With responsible management, flexibility becomes a powerful advantage. Myth number 10. IUL, loans and withdrawals, hurt the policy. It's true that loans and withdrawals reduce cash value if mismanaged, but when used wisely, they provide tax-free access to funds without harming the policy. Think of it as a safety net you can tap when needed. Susan, age 60, took a small loan for home repairs. She accessed funds tax-free and kept her policy intact. For her, the IUL became both protection and financial flexibility.